I launched a video recently explaining why fixed income investments, which make up a large part of people's balanced investment funds, have been hit hard this year, but also why the things that have made them suffer have improved their forecasted return significantly over the next decade. It was projected by Vanguard that for those of us buying UK bonds now, for example, the average forecasted return over the next 10 years was between 5 and 6% a year from the end of September, about the same as stocks are forecasted to produce, with half the volatility. Bonds have always been, and probably always will be, the asset class adopted by liability-driven institutional investors like big defined benefit pension funds to provide stable income. So in this video, I'm going to explain how you can do the same yourself using simple ETF building blocks. We'll discuss the starting point for building a fixed income portfolio. I'll cover the risks that you need to be aware of, and I'll talk about the characteristics of different countries' bonds and how you can use those to manipulate your growth and yield potential. I've also put some resources in the description below for you to refer to. If you're here for the first time, I'm Chris Bourne. I've been a financial planner here in the UK for the best part of 20 years now, and I help people achieve tax-efficient financial independence. If you like the sound of that, you're in the right place, as that's what all my videos focus on, so be sure to subscribe with those notifications turned on. With all that said, let's get into it. To research the content for this video, I held a call with Kunal Mehta, who's head of fixed income products at Vanguard, so an absolute expert on the subject, and I personally learned a lot during the call. But one of the first things he said was that bonds are there to provide four things: income, diversification, as in diversification to stock market risk, returns, as in capital growth, and liquidity. But the problem is that no bond or bond fund will do all of these things perfectly alone. Broadly speaking, if we split bonds up into two groups of investment grade and high yield, they'll each do different things better. Investment grade bonds are those issued by highly secure institutions where there's a very low risk of them not being able to pay your income and return your capital. So these would be bonds issued by the US, UK, German governments, for example, and very large, very mature companies with huge capital reserves. High yield bonds, on the other hand, are those issued by institutions of lower creditworthiness. These have to pay higher rates of interest in order to attract investment in the first place, but there's more risk of them defaulting, which means not being able to pay you the promised income or give you your capital back. So what you'll find is that investment grade bonds provide better diversification and better liquidity, whereas high yield bonds will provide more income and capital growth potential. What you have to decide is, what function do you want this element of your overall portfolio to perform? If it is more of a stable income that you're seeking, where the assets are easy to sell and therefore provide good liquidity, you'll steer more towards investment grade bonds. And a good proxy for those will be a global aggregate bond fund. This type of fund will invest only in investment grade government bonds and corporate bonds from around the world, with maturities greater than 1 year. Now, these funds have certainly been hit by the high inflation and rising interest rates seen across the Western world this year, but they have historically served as a good ballast when stock markets have been volatile, as I explained in a recent video about the Vanguard Life Strategy funds. This is a busy looking table, but what it aims to show is how well different asset classes right across the board, including stocks, bonds, commodities and property, have performed during various market downturns since 2004. And of course we've had a few, including the global financial crisis, the COVID crisis, and the current one that we call the stagflation crisis. What we can see is that over that timeline, bonds, and in particular hedged global aggregate bonds, protected capital pretty well when other parts of people's portfolios had fallen 30, 40, 50% in some cases. That's the diversification benefit they provide. Now this is actually a bit out of date because the data is only up until the end of June, at which point global aggregate was down around 10.5%. As I stand here today, that's more like 14.5%. But most experts feel that we've probably already absorbed the worst shocks in this asset class for now. The big thing that's changed though is that we're now going to be receiving more yield from these bonds. Interest rates have risen, which means that when new bonds are issued, they'll be paying higher levels of guaranteed interest. Kunal estimated the yield to be around 4.3 to 4.4% on the Vanguard Global Aggregate ETF at the moment. And as bonds mature over the coming months and years and are replaced by new, higher yielding issues, income distributions will increase. If we look at Vanguard's Global Aggregate ETF, over 70% is invested in A to AAA rated bonds, which are the most secure. And the largest proportion of the fund is in bonds with maturity dates between 1 and 5 years. It's these high quality, shorter dated bonds that historically have given us the best protection in stock market sell-offs. So as the first building block in any bond portfolio, a global aggregate bond ETF provides the widest exposure to the world's investment grade bond market. Of course, if you wanted income to be paid out, you'd simply opt for the income paying version of an ETF rather than the accumulation version. Now, for many people, particularly those who are relatively cautious and just want stable bond exposure to diversify the stock market index funds in their portfolio, that might be enough. And a global aggregate bond fund can usually be purchased at a total cost of around 0.1% a year. I've listed some of the largest global aggregate bond ETFs and their respective annual charges in the description below. It's important to mention a very important risk consideration here with bonds though, and that is currency risk. Because bond returns are generally lower than stock market returns, currency movements relative to the pound and holdings that are denominated in different currencies have the potential to nullify the return. It can work in your favour, of course, but it isn't a risk you really want to expose yourself to if you're looking for a stable return. For that reason, I'd say it's generally advisable to select funds that are hedged, which means the currency risk has been taken out for you by the fund's managers. And that leads on to another risk you might be thinking about, which is with interest rates still going up, which so far this year has been a big factor in why bond values have fallen, won't that push bond values down even further? Well, I did touch on that point in the same video I mentioned earlier. So to recap on that, here's another bit of data that shows some historical performance of bonds during previous rate rising cycles. The green line shows cumulative returns from bonds, and we can see that despite the US Federal Reserve, which is their equivalent of the Bank of England, hiking rates between 2004 and 2006, and again between 2016 and 2019, bond returns weren't significantly affected. The reason they started to fall so sharply here is because the rate hikes took the market by surprise. The main factor here is how much forward guidance is being given. When interest rate hikes are expected, they're priced in, and that lessens the impact when rate changes actually take place. For that reason, we may, but it's less likely we'll see further significant falls unless we're blindsided by some other unexpected inflationary event. So, if we wanted to add further building blocks to our fixed income portfolios, how would we go about that? Well, if it was additional yield we were seeking, that would naturally mean incorporating higher yielding corporate bond ETFs and emerging market ETFs, where yields could now be in the high single digits on an annual basis. But the trade-off is the additional risk to capital that would bring. You'd certainly find that instead of providing a ballast during stock market falls, these lower quality bonds would probably fall with stocks. But let's look at some of the characteristics of bonds issued by different developed world governments to get an idea of how we could tilt our portfolios. Starting with the UK, it makes up around 5% of the world's high quality bond market, which is quite small. But demand for UK bonds relative to supply is very high because we have a disproportionate number of investors that adopt liability-driven investment strategies, namely defined benefit pension funds. Now, these pension funds need the stable income provided by bonds in order to pay the pensioners in these schemes. So there's always a ready buyer for UK bonds. What it also means is that because pensioners need to be paid for a long time, longer dated bonds are in demand, more so than in other countries. Longer dated bonds are also more sensitive to interest rate movements than shorter dated bonds are, which contributed to some of the well-documented problems pension funds saw following the mini-budget in September. Rather than explaining all of that here, if you're interested, I've included a basic rundown of what actually happened and why in the description below for you. So taking this year with that LDI crisis aside, of course, the high demand for UK bonds tends to make the market fairly stable. And with the UK heading into recession, that stability may well attract investment. These are only predictions by people working in this field, of course. There's no guarantees that any particular scenario will play out. But the other thing worth mentioning about UK bonds is that there's no currency risk for UK investors to worry about. Looking at the US, relative to other markets, it's by far the biggest and most liquid bond market. And the duration of bonds compared to the UK is shorter. Now, inflation is still going up in the US, but that's arguably priced in, and the market does offer good value. So with America likely to head into recession over the next 12 months too, their bonds may also benefit from a flight to safety, which means when stocks are sold and the money recycles into high quality bonds. In Europe, the EU bond market is larger than the UK's and is quite diverse with lots of different countries. Having so many moving parts, though, can make the European market quite complex. The advantage of EU bonds over UK ones, however, is that the cost of execution is lower and liquidity is even higher, but yields are currently lower as well and always tend to be. Japan is an interesting one because while the rest of the developed world is winding down its quantitative easing, which is the policy of a central bank buying bonds in order to pump more cash into the economy, Japan are still doing loads of it. The reason for that is, for years, Japan has been trying to stoke inflation to reach its 2% inflation target, and it managed to reach and surpass that this year for the first time in a long time. But the Bank of Japan has decided to keep on pumping cash in to ensure that the inflation rise is sustainable. Government bonds there are highly liquid, probably only surpassed by the US in terms of liquidity. That government intervention reduces volatility as well. So Japanese government bonds could present a good opportunity. Remember though, as with any other non-sterling fund, you'd be inviting an additional layer of uncertainty if that currency risk isn't hedged out. And finally, just coming back to corporate bonds, it could be argued that some large companies are in a better position than some governments at the moment. Developed countries are moving at different paces through the world's current challenges and are at different stages of their monetary policy cycles. So adding exposure to investment grade global corporate bond funds could potentially add some positive diversification benefits with reasonable yield potential. The same caveats around currency hedging would apply, of course. So to summarise, a global aggregate bond fund would act as the base of a bond portfolio because it would provide an allocation to all of the countries I've just mentioned, and it's easy to access a currency hedged version of one of those funds. That's generally proven to be a good long-term diversifier to stock market risk, albeit not this year, and plenty of liquidity is inherent in those funds. If you are prioritising certain characteristics over others, such as more yield or less volatility, hopefully the information I've provided on the different developed economies will help with that. For more of an explanation about bonds and what has driven their performance and change in growth prospects this year, I'd recommend watching this recent video next, because I explain that in a bit of detail for you there. As always, I hope that's been helpful, and I'll see you soon.